Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, March 11, 2016. This week we'll look at Market Breadth Index, my long-term market model, which still shows that we are in a primary bear market. S&P 500 ETF SPY ended the week in the middle of a strong resistance zone. We'll look at McClellan Oscillator and what do the strong readings mean. Bonds are correcting within a context of a bull market on bonds. The dollar has surprised many observers after Mario Draghi announcement this week. We'll look at gold and GDX and see if it finally has entered a bull market. Oil and natural gas are bouncing off the multi-year lows. And finally, we'll take a look at agricultural commodities, which may be showing signs of life. Okay, so this is S&P 500, the index going back all the way to the 1970s. And I've shown this chart in the past. So what I did is I removed the price itself and I left the 50-day and the 200-day moving average in place. Now, in the upper part of the chart here, we have what's called MBI, Market Breadth Index. This is my proprietary indicator, which I use to judge whether or not the S&P 500 is currently in a bear market or in a bull market. This index has a very high degree of probability. It had predicted major bull and bear markets with a 90% accuracy. Now, when I say bull or bear market, I meant to say a series of higher highs or a series of lower lows, as in the case of a bear market. Occasionally we get huge drops, like for example right here, but they do not result in a continuation of a long-term bear market. One time it did miss the bear market here was in the 1980s, where the market breadth index thought that this is still a bull market, while indeed we had a series of lower lows and lower highs. Currently, the index is still in a bear mode. So in other words, the way I'm looking at the market right now is still from a point of view of a bear market that may continue for as long as bear markets continue. We don't exactly know when it will end. Here in 2003, we had a relatively prolonged bear market. Here in 2008, 2009, it was relatively quick and painless bear market, or rather, relatively quick and painful bear market. But those bear markets continue for a long time. So as of right now, I still do not have enough evidence to show that we have entered the bull market, and this will happen when this indicator has multiple inputs, and this is just a final digital form of the indicator. So it's in other words, it's either in a bull market or in a bear market. Currently, we're still in a bear market. Once the inputs for this indicator flip into the bull market, this index will go above this blue line, and at that point I'll say, okay, definitely we're now in a bull market. Now, as of the Friday's close right now, I don't think we're there yet. Okay, this is S&P 500 ETF SPY. So we hit 52-week lows here in January and February, and then we rebounded with a pretty powerful rally. This is about 12% rally right here of the lows. Now, as I just showed in the previous chart, I still think that the stock market is in a primary bear market. So this pretty powerful rally of 12% plus, I still think is a counter trend rally. In other words, the bigger trend is still down, and this is a counter trend rally. Now, currently we are trading above the 200-day moving average, this green dotted line. Also, here we have a very large gap down from the first day of trading of this year, 2016, which is in the process of being filled. So, if you're a bull, that's a good sign. maybe we'll continue higher, maybe we'll make an all-time high. But as of right now, once again, I'm still treating this rally as a counter trend rally. There needs to be quite a bit more a breadth improvement for this primary bear market to reverse. So I think that if the bears are going to come out of hibernation, this would be a good sign, a good time to do so here. Possibly we'll continue higher, and here we have really strong resistance from this prior peaks here. Down below here we have a bullish divergence, which is again a welcome sign for the bulls. This is advanced decline line, so the number of stocks are pushing higher. You know, it's a good welcome sign for the bulls. However, as far as the volume is concerned, we have not exceeded these highs here just yet. So I still, there's quite a bit of work for S&P 500 to do still. Now, this week, I received an email from McClellan Oscillator, Tom McClellan, who is a publisher of McClellan Financial Publications, very respected technical analyst. So he mentions that McClellan Oscillator had the highest reading in 7 years, right here. So that's interesting sign, and he continues here and discusses what he thinks of this whole thing. Basically, he thinks that this could be either a initiation of a new uptrend, or it could be a climax of a bear market rally. Now, of course, as I just said before, I think that we're in a bear market, so in my opinion, this could be a climax of a bear market rally. Next several charts, I'll show a different version of McClellan Oscillator, which I actually prefer, and we'll see how the historical examples pan out to, compare to the current high readings. Okay, this is a chart of New York Stock Exchange Composite Index. This indicator here in the upper part of the chart is a New York Stock Exchange Composite breadth momentum oscillator, and this is a version of a McClellan oscillator as modified by Carl Swanlin, who is also a very good technical analyst, very respected in the field. Now, we have a very high reading of ITBM. It's currently at 195, and my question was, is this possible to have during the bear markets? Is it possible to have such large and powerful readings for breadth? And I went back and I had to, and I found an example back from 1973-75 bear market, and then we'll look at those next. Okay, so this is a chart of NYSE Composite Index back in 1973-74, actually 73. So here, this is again market breadth index, and my market breadth index goes back to 1970, and this is a bear market that it called back in 1973 in July, entered into the bear market. Now notice that immediately the price did not collapse, and in fact we had a pretty powerful rally. So here in the lower part of the chart we have New York Stock Exchange Composite ITBM, as just I showed in the previous chart, and it also registered a pretty high reading here at 202, and this is a high reading for the bear market. So here we have the prices in black, and then the 50-day moving average and the 200-day moving averages. So after this high reading, we had a price actually above the 200-day moving average. So now let's see what happened next after this high reading was registered. Okay, so this is the same chart of NYSE Composite, and here's that high registered reading in the ITBM in breadth momentum oscillator. After this high reading was registered, notice that the primary bear market continued, and even though the MBA market breadth index did rally somewhat, it did not exceed the bullish threshold. So at this point, I would have considered the market still to be in a bear market. On top of that, you can see the 50-day moving average actually crossed above the 200-day moving average. And this is one of the ways that people quantify the whether or not the security is in a bullish or a bearish market. So what happened afterwards? After this reading was registered, the NYSE continued down for another year and lost an additional 45% of its value before finally bottoming out in October of 74. So basically the bottom line with this picture is that currently we had a high reading, but those high readings in breadth momentum does not necessarily mean that we are going to enter a new bull market. As a matter of fact, as I just showed, we can continue lower and significantly and continue to have significant losses. Bull market finally started per my model here in the middle of April of 75. This is the same chart as I just showed for NYSE Composite, but we fast forward to current 2016 picture. You can see the bear market started somewhere around September per this system, somewhere around September of last year, of 2015. As of right now, I don't see any signs that this bear market has ended. As a matter of fact, this picture is significantly more bearish than the one in 1973-74. Notice that here we have both the 200-day moving average pointing down and the 50-day moving average is pointing down, and the price itself is still below the 200-day moving average. We do have a very high reading in the breadth momentum oscillator, but this could be just a very overbought reading for this current bear market. Can this change and can we just continue to skyrocket higher? Absolutely, it's possible, but we need to see evidence that we have switched into the primary bull market, and only after that I will start looking for buying opportunities. As of right now, I'm only looking at selling or shorting opportunities. Okay, that's it for stocks. Let's continue next to bonds. This is TLT, iShares Barclay 20 plus year Treasury Bond Fund. This is a pretty volatile security actually, and surprisingly enough, it is more volatile than the stock market S&P 500 itself. Anyways, so we had a breakout here, several breakouts here to new all-time highs, and now looks like a correction, possibly like a falling wedge or a flag of some sort. Excuse me. So once this correction is over and prices start to rally again, I think a breakout above this level here, above maybe 131, would likely signal a continuation to to challenge all-time highs again. This is especially likely if stocks finally roll over after this 12+% rally of the lows. Down below here we have on balance volume. You can see it's making higher highs and higher lows. So there's certainly good volume patterns present in the bond market. Okay, this is AGG, the Diversified Bond Fund. Also very similar patterns to the TLT. We had several breakouts here, all-time highs, and now some sort of a corrective pattern. This could be like a pennant of some sort. Not sure if we're done correcting. Maybe we'll correct back, further down to the 50-day moving average and the breakout level here. But if we are done correcting, then a breakout above maybe 109.90 here, above this level, most likely we will see another re-challenge of all-time highs here. And again, certainly if the stocks roll over, this will most likely happen. Again, same thing with on balance volume patterns. This is very good looking pattern. There's no bearish divergence, and the volume is signaling that money is certainly not leaving bonds just yet. Okay, so this is a US dollar index end of day chart. This is going back 11 months. So we had an interesting this week we had an announcement by Mario Draghi to increase um, bond purchases and even push the interest rates even lower into the negative territory, further into the negative territory. And so basically they're printing euros, while the market itself, the traders themselves, thought that this was actually bearish for the dollar. Now, this is exactly the kind of reaction that you would not expect. Like, I would expect in the opposite reaction. And if the market, if Mario Draghi will print more euros, the supply of euros will go up, then they become cheaper. But actually, the exact opposite has happened. We will see if this is going to change the long-term picture. I still think that the long-term picture is bullish for the dollar. Also, Wednesday, March 16, this coming Wednesday at 11 o'clock, there is going to be an Federal Open Market Committee decision on the interest rates. So who knows, maybe they will decide to increase the interest rates, and this would certainly be bullish for the dollar. Next chart, I'll show a more longer term pattern for the dollar. Again, this is quite bullish. I think we had a bullish breakout here in 2014. Maybe we're in some sort of a inverted in a cup and handle pattern of some sort. And if we come back here to the 100 area and then a final breakout here, this would be certainly very bullish. If we do break out above the 100 area, then the depth of this cup pattern is 9%, and we could easily move 9% up. Okay, switching gears to the commodities part of the presentation. We're looking at gold, going back to 1980s here. Again, same thing as with the market breadth index. I created my own gold breadth index, which seeks to figure out if gold is in a bull market or a bear market. Now, I've shown several versions of this chart in the past, and this week I was playing around with it some more, and I was able to narrow or rather reduce the number of whipsaws even further. So here we have in the upper pane, in the upper part here is the gold breadth index itself, GBI. It consists of multiple inputs, so it's it's a result of many inputs related to the gold and gold miners. So here we have basically a 90% accuracy with the calling with the whether or not gold is in a primary bull or a bear market. Here in 1995 we had a whipsaw, so this was a bad signal. But the rest of the signals were pretty good. Even this one, you can say that this was a whipsaw, but this probably was an okay signal. Probably would have made money here. One of the inputs for the gold miners, for the gold index, GBI, is the gold miners in an uptrend, and I'm looking for this index to go above the 80% here. So far, I have not seen it happen. So if it does go above the 80% mark, then I will certainly say that I will start treating gold as a bullish security. Until then, I still think we're in a primary bear market that started sometime in 2012. So based on that, I'm looking for shorting opportunities in gold still. Okay, this is a gold weekly chart. Even if, let's say that we are indeed now in a bull market, a normal retracement after this very powerful move of the lows could be that gold will correct back down to around 1190, possibly even lower. So these are Fibonacci retracements, and a normal retracement of about 38% of the high here, maybe even 50%, possibly even 68%. Will take gold in this area from 1140 to around $1,200. Now, it's possible, again, that I said before, that we're still in a primary bear market for gold, so we could easily, correct all the way down and make a new low. Again, I'm not perma bull or perma bear in gold, but I am looking at objective evidence, and this objective evidence is still telling me we are in a bear market for gold. Looking at the recent action in gold, looking at the candlestick specifically. Now, this Friday's candlestick should worry the bulls very much. It shows two things that are not good for the bulls. Number one, this long tail out of the top. So this indicates that the price a certain time during the day attempted to go higher and it was sold off. So this looks to me like a rejection candle. Rejection part of the candle here. The second part is that the price ended the day near the bottom, near the bottom for the session. So there are two things within this candle. Is that number one, we have potentially a rejection candle, and number two, there was selling pressure throughout the day. Could this be the beginning of a pullback in gold? It's entirely possible. Again, we had several rejection-like candles in the past here, and so far they have not worked out, but we'll see if this one does work out. Now, again, so far I have not seen enough evidence to say that we are in a bull market for gold. So again, I was looking for only shorting opportunities. This is GDX, Market Vectors Gold Miners ETF. Pretty similar picture. Of course, this is extremely more, quite a bit more volatile than gold itself. So this was a very powerful move. This is what, like 75% or so move from the lows. This is all-time lows here. Similar pattern for the candle on Friday. Looks like a rejection from the top and possible and the selling pressure towards the end of the session. Again, we had several similar rejection, bearish engulfing, possibly rejection candle here, and so far they have not worked out, but we will see if this one does work out. Further down below, we see that gold miners market breadth did improve. We see, advanced decline percent, advanced decline volume percent has improved, and balance volume did improve as well. Gold miners bullish percent index may have rolled over, so it looks like we topped out around 72%, and now maybe we're dropping. Now again, anything is possible, especially with FOMC this Wednesday. Should they decide to continue with their loose monetary policy, we could see gold continue higher. Alternative scenario, as I said before, we could easily correct maybe to the breakout level for GDX around 1690, possibly even lower, possibly completely fall apart and make new all-time lows. Okay, oil, West Texas Intermediate, crude oil spot price daily chart, end of day chart. Similar pattern from last week, didn't really change that much. Showed this possible rising wedge of the multi-year lows. Looks like this rising wedge continues. So far, I have not seen a major breakdown of this wedge. A close below maybe $37 or around $36 would definitely break this particular structure. Generally speaking, oil is bearish, multi-year lows. There's tons of resistance around, from various patterns up here and broken supports. Also, we have a bearish divergence here for unbalanced volume. Looks like we're pushing lower for unbalanced volume while the price is moving higher. So I don't see anything really bullish to get excited about this chart. If anything, this is a short setup. Okay, this is natural gas spot price daily end of day chart. Last week we hit multi-year lows here on the natural gas. Then I said that a counter trend rally is certainly a possibility. We are getting this counter trend rally. Maybe this is a rising wedge of some sort. This Friday, this could be like a rejection candle. So I mean, again, nothing really positive about this chart. Possibly we get a retrace maybe to the 50-day moving average. Like here we went above the 50-day moving average and then continued higher, but then we failed here at this resistance from this high. Maybe we'll just fail and collapse. We don't know. I mean, it's really difficult to say. I mean, I don't see really a turnaround in prices for natural gas just yet. Same below here, unbalanced volume is pushing lower. So, there's really no divergence as far as possibly a bullish divergence for natural gas. Okay, and finally, let's wrap up with multi-sector commodity agriculture fund. This is a diversified agriculture fund that holds, I believe, several various futures of various agricultural commodities. Now, these are all-time lows, in fact. But since this is a fund that holds futures, it's really difficult to say that there's indeed it's not really an all-time low for the index itself that it follows, because there is slippage and it loses its value. So generally speaking, this is a very bearish patterns here, but we are seeing some sort of a rebound, and a pretty powerful one that at that. There are some constructive patterns in various agricultural commodities that possibly may be signaling some sort of maybe an intermediate bottom, and maybe even a long-term bottom in agricultural commodities. I'm not really calling this a bottom yet, because most likely we'll see a retest again. Now, but it's just something to keep on your radar. Maybe if we see a nice rally and then a pullback, and then maybe we'll hold on that pullback, then something to consider if you're looking to diversify your portfolio with some agricultural commodities. This is certainly very unrelated to other, stocks or bonds. It kind of dances to its own drummer. That's it for this week's recap. Thanks for watching. Please stay tuned how to find us on the internet, and have another great trading week. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services that are now active. Please consider subscribing. You get 3 weeks free trial, and it's only $24.95 per month thereafter. You get access to my charts, exactly what I'm buying, exactly what I'm selling. I have an internal blog. Also, I have several videos that have to do with trading and various aspects of risk control, as well as just a psychology of trading. So please do consider signing up. The subscribers are getting really good results, I think, and I'm getting some very good feedback. I have a performance section here where I post the actual portfolio percentage change. The inception date was in 2015 October, so it's not a lot of history yet. And there's some backtesting results that I feature here as well. The blog, of course, is where you'll get this information, and there's a video section where I separate them out for easier access. Click on the social page, and here we have a link to public charts page where most of the charts that you're seeing in this video are going to appear. If you have Twitter, Facebook, YouTube, StockTwits accounts, you can find us there as well. If you subscribe to our mailing list, you'll get a special price for our trade alert services. That's it for watching. Thanks for watching, and have another great trading week. Bye-bye.